my head remains with my core framework, which has been we are still in a disinflationary world and that interest rate rises are self-limiting because everybody's too indebted and the aging population, and that trend in bond yields they call the chart of truth, where bond yields go down over time, holds. That is currently the least popular view from most people, everybody, and I've interviewed everybody that I know and really respect, just did it into Games Aitken, Gerard Minacom, Karol Sokolov. They've all changed their macro view. They're like, structurally we think there's long-term inflation, and their view is we think there's long-term inflation because of the amount of spending that will happen to transition to and that's there's not enough commodities to deal with that. Absolutely true that supply chains are coming back to regionalized, so people need to build new factories, and I think that's true too. I still think that the demographic story is larger and that demand for commodities is driven by the economy itself, and so I know it's fiscal stimulus, but at the margin, if households spend less then the price of commodities comes lower. I think overall I still think commodities come lower than here. The big question for me, I think we're headed towards recession now again. As ever, everyone's saying, well, this time it's different. The forward part of the twos curve doesn't suggest interest rate cuts. The 3-month 10-year is not inverted. There's always a but this time I generally look at all the forward-looking indicators that I've been using for the last 20 years. Most of them are weakening, showing weakening growth. I don't have many things that give me a recession yet, so it kind of feels like 2006, where the yield curve remained inverted for a period of time before the actual bad news comes. I look at shipping freight, all of these indicators, a year-on-year rate of change, they've all gone to recessionary levels, so something's going on. Consumer sentiment, the University of Michigan's consumer sentiment indicator is recession levels. It's consistent with the yield curve and small business optimism falling, not yet at recession levels. New orders falling, not yet at recession levels. Year the equity survey, the Economic Research Cycles Institute, that is again pretty low, near zero. So there's a lot of indicators that are like, listen, is likely to get down to between 52 and 50 between June, July, something like that. Usually the Fed stops when that happens. Most people are expecting something much more dramatic, which is that inflation stays much higher. I don't know what that means, whether they're talking about 3%, 4%, or I would suggest that CPI stays between the 2 and 3% kind of 1 and 3% area, so in that maybe bond yields trade sideways, but I don't see them breaking out from 3%, which would be a new high, cycle high that we've not seen before, because that's not happened in 35 years. So we'll wait and see him. It's a big picture change. That the Russian situation is like the Arab embargo, so we've seen that before, but then this massive shift to a which is a huge kind of global stimulus where the economy needs to retool, that the Europe needs to retool its entire economy. But we've also never had that with the largest amount of aging population of all recorded history and the largest debt load. So who the hell knows? If you want to watch the full interview, check out the link in the description. What do you think of Raoul's thoughts here? Are we heading for a recession? Comment below. Thanks for watching, and we'll see you in the next video.